Support for the show comes from Capital.com, a global investment platform that aims to accelerate financial inclusion worldwide. I recently spoke about the need for everyone to be investing, and I think financial education is key. For that, I invite you to check out Capital.com's website and look at their education hub, which has in-depth courses to help you. For seasoned traders, Capital.com offers 24-hour support in over 10 languages, news, insights, and reports to help you make informed decisions. Check out Capital, that's Capital.com. Hi, everyone, and hello, 2024. Welcome to Conversations with Loulou, the top 10 business and entrepreneurship podcast in the Middle East. This is part 2 of the 2023 wrap-up. If you haven't done so already, I invite you to check out episode 64 of Conversations with Loulou, which is a wrap-up of 2023's biggest aha moments. In this episode, I'm going to be wrapping up 2023's most practical advice. I've scoured the 19 conversations that I've had with entrepreneurs, business leaders, and industry experts to distill the most practical and pragmatic advice to give you some insight that hopefully would help you on your professional journey. So let's explore some of these golden nuggets together and figure out what makes my guests successful in their own game. Like, you have to work hard on getting there. You have to prepare. You have to work on yourself, improve yourself. I think people sometimes look at successful people and they think it's an overnight success or they were born that way. But it's hard.
So I like the idea of relentless consistency. Mm-hmm. Okay? So it's the idea of being consistent is key. Meaning, if you're going to commit to doing something once a week, you blinking do it once a week, right?
Yes.
So an example would be this, what we're doing now. You know, you're committing, so you show up, right? It's not about perfection. It's being relentlessly consistent and just keep doing the work.
While having a big vision is important, as well as your ability to be a great storyteller, success is usually about patience and tenacity to go through these mundane, the day-to-day, the boring stuff. It's like dieting, it's not the crash diet that will get you to the great results and sustainable results. It's the day-to-day, getting up, going to the gym, exercising, eating healthy day in and day out through thick and through thin. This is what leads to ultimately sustainable success. And if you've been watching this podcast, you would know that there is no such thing as an overnight success. And all of the entrepreneurs and leaders and experts that I've had on the show have had one thing in common, which is that resilience trait, that tenacity to keep going through thick and thin.
It's super intense. I mean, that's what nobody talks about. Like, what most people talk about entrepreneurship is, like how, it's all the fun stuff or the spotlight or whatever. But there's a lot of crying. There's a lot of, I'm losing my mind. There's a lot of, the basic thing is that you have to keep going.
They say that luck is opportunity meets preparation. Why do some opportunities present themselves to certain people and not others? Here's what Nima Abouwerde, ex-BBC presenter, journalist, and communications expert, had to say.
Perception is the feeling that people have about you, even when you're not in the room. That's how I see it, right? So even when you're not there, oh yeah, Loulou, she's like this. It's like, yeah, it's the presence and perception, these two P's, yeah? So presence is like, oh, what's that feeling that people got from being in your company, yeah? That's what they remember more than anything else. Like, really great person, loved being around them. Can't remember anything they said, but it was a really great person, And now perception is actually more important than presence, because perception is what people think about you when you're not there. It dictates what people offer you or don't offer you, because they make decisions about you based on judgment calls. And it could be, Loulou, we're inviting you to be part of this team because we perceive you as somebody who is able, capable, brilliant at this. Or Loulou, we're not inviting you because you just, and this is a true thing, you just gave birth, not you, I mean, this is a situation that happened, yeah? You gave birth, so we're not even going to talk to you about this, even though you are the best person for this role. Do you see? So, I mean, these are different bits of thing, but bits of how to navigate this sort of stuff, of being in the mix. And I think the biggest question to ask ourselves, if you want things like to be considered, is when an opportunity that is great for you or for your product, if you're selling something, comes up, do the decision makers, do they think of you or not? Mm-hmm. Because it's not about who you know, it's about who knows you and their perception of you.
Now that you've gotten called upon and that opportunity has presented itself to you, how do you gain that confidence to grab the opportunity by the horns? Here's Nima again.
I mean, for me, it really boils down to, like, for example, people say imposter syndrome, fraud. Mm-hmm. These are things that come up, right?
Yes.
Personally, I don't like those phrases for specific reasons, which include things like that are condemning. You can condemn yourself. Oh, I'm an imposter. I can never do this. Or somebody else can condemn you. You don't have the credentials. You are a fraud, right? I like to, again, break it down. All right. What it boils down to is the 3 C's. I call it the 3 C's. So it's about you feeling comfortable, credible, and consistent in the way that you show up. So feeling comfortable, credible, and consistent in the way you are equals you are confident. Instead of because let's say you are up for a promotion if you work in a company, or you are pitching for business if you own your own company, for example, yeah? People do walk away thinking things like, that person isn't confident. So it's a label, a takeaway feeling. But when you break it down into, okay, what is it about that interaction or that person that makes that feeling happen? Is it that they are not comfortable in how they are? Literally, physically. Like, literally, it's about what you're wearing as well. Like, am I comfortable? Am I okay? Do I feel like me in this? That's one. Comfortable in what you're talking about. So credibility is key. If you don't know what you're talking about, you shouldn't blinking be talking about it, okay? So you go and you find out your facts, or you hand over to the right person. And consistent, what do I mean? It means if you want to be known for something specific and you have the opportunity to share or be part of something and you say no, wait a minute, are you the person who is supposed to be known for this or not? Are you the person that we're supposed to come to for this thing or not? So, it's a bunch of things, but it boils down to, if you want to be, I don't like the word confident, but if you want to be, let's say, confident, then you need the 3 C's. You need to be comfortable in how you are, what you're saying, what you're doing. That comes from having credibility. That is at the core of everything as far as I'm concerned. And being consistent in how you show up. So what's your messaging? Literally, I am the go-to person for this stuff. I own this space. This is me.
After spinning off the Careem super app and getting a $400 million investment from eAnt, which is formerly Etisalat, Mudassir Sheikha, the co-founder and CEO of Careem, wrote a post on his LinkedIn page with the reasons why not to join Careem. So I wanted to ask him about that. Here's what he had to say.
We're not inviting people to join Careem and be employees of Careem. We're inviting people to become owners, co-owners of this mission with us. And in so many, one term that is used when we talk about mission, we're companions in this mission, right? Versus something else. So for the people whose mission, broadly speaking, align with Careem's purpose, this is incredible. And for those people, yes, we still have to pay them decently well so they can look after themselves and their families. But they'll have to just join this mission and make something big happen out of it. We still have to make sure that they have long-term upside in being a part of Careem. Mm-hmm. We still have to make sure that they're not killing themselves while working at Careem. But outside of that, it's really the achievement of the mission, achievement of the impact that we want to make on this region. That is the most exciting thing that people should join Careem for. Mm-hmm. Everything else really fades in comparison. And I'll give you some examples. In chapter 1 of Careem, we were scrappier than today. But, I remember we had a salary cap of $150,000. We said we're not going to pay anyone more than $150,000. Mm-hmm. A lot of people that we wanted to hire were making a lot more than that. And frankly, there were some people that were extremely well qualified, but this artificial cap that we had put on ourselves kept those people from joining. But the people that walked in through that door, even though they were making 2-3 times that number, are still with Careem today. Because they joined Careem for the right reason. And they have the most passion, the most drive to make Careem's mission come to life.
Yeah.
So if anything, we're hoping that that post that we put out keeps the people that are not aligned with this purpose and mission away, so that we can actually get the right people in who will be around with Careem with a lot of passion for the next 10 to 20 years to come.
Now, you may say that this would only apply to startups because entrepreneurs have this flexibility and the ability to give people upside through equity, right? But remember, before the Careem exit, there weren't many exits in the tech sector in the Middle East region. In fact, even today, they are still outliers and not the norm. So talented people are taking on big risks by joining startups because they could get zero upside while taking on a lower salary. So there's an opportunity cost to that decision. What I'm trying to say is that, the advice that Mudassir has given us doesn't only apply to startups. It also applies to corporations, because you don't want people hanging in there just for the salary, right? It's a recipe to slow death and lack of innovation. So if you are a manager in a company, or if you are a business owner, I think Mudassir's advice is very important, because you want people who are fully bought into what you're building and why you're doing it, versus being there just because, the salary and the benefits are nice. Building a startup is very, very hard. It's not glamorous. We only hear about the 1% of really successful entrepreneurs and their glamorous lives, and it's great. But we don't often hear about the 99% that are trying and are failing and trying again and failing. Failing and rising again is the stuff of champions. Here's Ali Halabi, the founder and CEO of Volt Lines, talking about the decision to shut down his previous startup, Volt.
I think the interesting part of this story is how stressed I was about this failing. I was like, what will the investors say?
Yeah, how long did it take you to realize that this is not working? Did you run out of money, or before you ran out of money?
I think running out of money is like my national sport. I think it's not just me. I think it's every startup. Every entrepreneur.
Yeah.
The art is to avoid that as much as possible, and to kind of like build the alarm system in these. When you have 6 months of runway, or 8 months, ideally 9 months of runway, you should ring the alarms and start working on fundraising, because fundraising takes time. We ran out of funding multiple times, but really, we had a lot of strategy work, and we have written down what needs to be done and what metrics need to be achieved. Because there's this, kind of existential question where you ask yourself, like, when do you say enough is enough, or when do you, pull off the plug, right? And that happened in a board meeting, right? So I was speaking with Walid Mansour from MVP, and at one point he's like, "There's no product market fit, man. Like, find something else." And when your board says that, it's like, and you don't have any further argument, the next feature fallacy won't work here. Like, if we build this, it will work. It was, the data was clear. The jury was out.
And you were convinced?
I was convinced.
Okay.
I was convinced. I was like, because at the end of the day, as a founder, you're like, and this is what most people don't, I think about or realize, is that, yes, there's an investor who put in like $600,000, let's say, right? Or $1 million. But you're putting on your opportunity cost, right? You're putting on your time.
You're the entrepreneur.
So you don't want to be just like emotionally connected to it, right? It's an asset class, right? For other investors, it's not their whole. But for you, it's everything, right? So how do you value your time and your life and the years you spent? And that's where, I became philosophical about these things. And it came to a discussion. And I think, I really, Walid Mansour.
Yes,
yeah.
of course.
So I really appreciate, I still remember this conversation. Not a lot of people know about it, or haven't maybe publicly spoken about it before. But I love what he said. He said, listen, don't worry about, yes, we invested. MVP was the biggest investor in Volt. And he's like, we are venture capitalists. This is our business model. Some startups will fail. we know that. It's in our math. It's in the VC math. And he was like, we like you as an entrepreneur. You're data-driven, you're resilient, you have all the qualities that we like. So try to find something else. Try to pivot. Try to figure something out. And I won't promise that we'll be the first to back you, but if we like it and it has traction, maybe we'll back you again.
Sometimes building something new and getting started can feel so daunting, right? You have this big vision, you have a plan, you have some form of idea of what you want to do. And then you think you're going to need a lot of resources, a lot of money. Everything needs to be perfect. The product has to be perfect, or the service that you're offering needs to be great from day one. We have a saying in the startup ecosystem and the startup world, and I think it should be applicable everywhere, which is, building a minimum viable product. It's actually the most basic version that functions, but it doesn't necessarily have to have all the bells and whistles. It doesn't need to be great. It just needs to work. So sometimes getting started is much, much simpler than you think it is. So here's Hassan Jafar, the co-founder of Karzati, talking about how he and his co-founder, Marwan Shahar, got started. How did you test it, Hassan? How did you decide that this is the business model that we're going to do? Was it your life's passion or?
Far from it, right? Far from it. No, so, it started off with sort of a whiteboard and saying, okay, what business models make sense, right?
Interesting.
And so we had a criteria of, 10 or 12 different metrics or criteria we needed a business to check. And we narrowed it.
Share something like?
I mean, we cared about sort of, things that were attractive about the used car space. It was a large market. It was fragmented. There was bad customer experience that we can fix. A lot of the Porter's 5 Forces type framework were attractive when it came to the used car space. So what that meant was the business would have very healthy and very attractive unit economics. And that was extremely important for us, right? From the very beginning, as we were looking at different business models, we narrowed it down to 2 or 3 models and we tested them in MVP format. But then very quickly, this is the business model that sort of stood out as both having attractive unit economics and something that could become large. Going back to how we tested it, literally, I think created a WordPress website over 2 or 3 days, found some cars online, posted them, spent $50 on Google Ads, and we got our first sort of customer come in, walked in and said, I love this concept. Can I share this via WhatsApp to my sort of friends and family? We're like, sure, why not? We welcome sort of word of mouth marketing. And as soon as he sent that message, the next thing we know is we had 300 customers standing outside. We had a little office, me working part-time. We had another guy working part-time. This is sort of still in the MVP testing phase. And me and Marwan were brainstorming. And we have 300 customers standing and the phone is ringing nonstop. And I'm like, holy shit, what do we do? Yeah. So everyone's coming in. Okay, I want to buy this car, that car, which is online. We didn't actually have the product. We're like, great, just give us your information and we'll get back to you. Give us your information, we'll get back to you. And we did that for almost a week where people were coming nonstop. And that's when we knew that this sort of had legs, this had real traction.
And then Hassan and Marwan get an offer from Kavak, which is a global player that wants to enter the Middle East. They got an offer to sell Karzati, which they did for tens of millions of dollars. And I asked them, why did they sell? Why didn't they just keep building? How big could that opportunity have been had they continued? So here's what they had to say.
And Kavak went from sort of being below $1 billion to $1 billion, then $4.5 billion when we started the discussions, and then $8.7 billion valuation, while we're still negotiating the deal, which made it hard for us to sort of negotiate the deal. But at the same time, there were other players in other markets that were looking to enter the region. And so what ended up happening was we had this sudden influx of sort of global players that were calling, and it was there were 2 other contenders that were interested in the acquisition. So that helped us a lot because we were able to then play the dynamics of sort of multiple acquirers and negotiate sort of the best deal we can by sort of having multiple offers. But it was very much a position where a lot of money came into the sector. Players wanted to sort of put their flags everywhere, and this was sort of an opportunity, and we were there.
Okay, but I mean, here's the critique to entrepreneurs, right? Why wouldn't you carry on? Like, why wouldn't you build a $200 million company, which was your goal, right? With 200 employees, 500 employees across the region. Why sell?
So look, ultimately, when we did the math in terms of what the returns would be for our investors and for us, with raising another round and the dilution that would come with it, the exit we got was no different than the exit we were looking for. So from an purely economic perspective, we hit sort of what we were looking to hit. From a sort of why sell at that point and why not build it to not even 200 million, why not even a billion, or why not even compete, right? I think we were, so there were a couple of different factors here. One part of it was definitely we had a view that valuations were frothy, right? And there was a lot of capital going into the sector at the time. And we didn't think that what was happening in the tech sector was sustainable, right? We were both old enough to have lived through the 2008 financial crisis, to remember the 1999 tech bust. So we knew that, just from a fundamental perspective, what was going on did not make sense. So again, this could have lasted another 5 years, another 7 years. We didn't know. But what we knew was what we had on hand was attractive for our investors. It was attractive for the founders. And we knew that the market wouldn't stay the way it is always. So we weren't trying to be greedy.
Sometimes a sale is not necessarily the end, right? Unlike Karzati, Ali Halabi had to take back his startup Voltlines after having it sold to Swivel. So they go public and you are popping the champagne and you're like, okay.
So no, I'm not. So they go public.
Yeah.
I'm not popping the champagne. I still remember the share price before the share split. So it was like $10. It went down to $6, $7, hovered at $6, $7, and then went down to $3. Then down to $2, down to $1. And that's where we're like, okay, what's happening? Meanwhile, Voltlines not only doubled, it also became profitable. So here you go, you have an asset that you sold that got better, whereas the acquiring company is getting, I wouldn't say the company was getting worse, the valuation was getting hammered, right?
So that 32 million went to nothing, basically.
Yeah.
Like 2 million or something.
Bag of peanuts is what most of my investors were calling.
Yeah.
There were like red alarms everywhere. But one
So
thing
you weren't rich. I mean, you weren't rich.
No, I wasn't rich.
You were in trouble. You were in trouble.
Yeah, I was in trouble. And the thing is, like, when the company that, like, you sold the company, right? By selling the company means you transferred the shares of your holding company. So Voltlines BV in Amsterdam transferred the shares. So we don't own it anymore. And now
So you're an employee of Swivel.
Yeah. And I'm waiting for a payment, right? If anything was to happen to Swivel, if Swivel, God forbid, filed for bankruptcy, we would lose everything. Like, we would be left out in the cold, right? And then I got a call on 14th of November, 2022, basically saying, hey man, we need to extend the deadline to end of March. I was like, no way, no, we can't. We can't make it, etc. I'm like, okay, I need to speak with the board. I spoke with the board. The board was like, immediate, like, no way. By the way, there's no board, technically. The previous board, like, we kept the WhatsApp group, we kept the conversations, etc. And basically we said, okay, no, because we knew that they won't be able to pay because, they had to issue 17.8 times more number of shares, right?
Because of the caller protection clause.
So, like, could have made us the majority shareholder, but, like, did we want to deal with that mayhem? We said no, like, and investors asked me. By the way, some investors were worried that I'd be like, you know what, guys, this is your problem with Swivel, go deal with them yourself. Some investors were super happy. Still, like, get a lot of cheers and respect from Basil Muftah. and I love him a lot.
I've had him on the podcast.
I watched that episode. He was one of our angels, very early angel investor in Vaultlines, and he's like, man, you could have left us. You could have left all of your investors in the cold. You could have said, just not my problem. I sold the company.
We sold the company, yeah.
But the fact that I was willing to go back to the trenches showed that. And by the way, I did not do it because I'm a hero or I have a higher ethical standard or whatever. But that was, again, my belief is that this asset is worth millions of dollars and should not go under a bigger crash, right? And the proof is a year later, today, Vaultlines is a profitable business, right? With a meaningful customer base and an ample room for growth. So that's why I was like, no, I want to get the company back. And yeah, we started the negotiations with the Swivel guys, and they were going through hell. Like I really appreciate the intensity of what they had to go through, and they kept a very kind of level-headed approach to the whole thing. Everybody was super professional. Yusuf did a fantastic job managing this whole thing, and we ended up breaking up in January 16th this year. This is when we signed the reverse SPA, a new SPA where we got back the shares. And basically, but
so you're default alive now as a company as well.
Yeah.
You're EBITDA positive.
We're EBITDA positive. I mean, what's in the bank is basically that it's a $10 million business that's EBITDA positive, and now and it's EBITDA positive for 3 months now, right? So the question is, do we want to continue running a $10 million business, or is it time to make it? And that's why like a lot of the stories. A lot of companies, it takes a while. I mean, it's been 6 years, the whole Vaultlines journey, right? So, yes, you think you'd make it big, because in 2019, I was thinking, or in February 2020, I was like, wow, we're tripling every year. This is insane. But then, you get humbled by something like COVID, and then the crisis in Turkey, and then you're running out of options. There's a storm coming. The Federal Reserve started hiking. And then you take the company into a safe harbor by selling to Swivel. That safe harbor starts crumbling down. So you take the company out and then continue. It's an intense journey.
If one thing comes across so clearly in the 19 conversations that I've had this year is that it always boils down to the founder or the founders. Whether you are investing early or you are investing in a $100 million company, it always boils down to the people who are leading that company. I've heard the saying, venture capital investing is more art than science. I've heard it through so many people locally and internationally, and it's true. Here's Mudassir Sheikha talking about his investment criteria, which I think might surprise you. Mudassir invests in early stage companies, which means, people are still at the beginning of building the product.
So I'm less interested in financial returns when I'm investing and writing these checks, and more interested in supporting purpose-driven founders, build things that can sort of improve things for the people of the region. Mm-hmm. So my investment criteria is relatively simple. If you are a purpose-driven founder who's doing it for the right reasons, not to just make a ton of money for yourself and become rich and make your investors rich, but there's a deeper drive for something that's socially related. That's important for me. And second, you have to be capable. You're not going to build something amazing by just being purpose driven. You also need to be super capable. You need to be willing to work really, really hard. You need to be able to make the sacrifices that are required for this journey. So if I see these two things in someone, then I'm more likely to write a check than if the business is exciting and if the growth is there, but I don't see these two things.
Mm-hmm. So you want to see yourself, a younger version of yourself.
But I think there's,
hardworking, vision-driven.
Hardworking, vision-driven, fine. But I think the region needs it, right? I think the region needs it.
I'm not saying no.
Yeah.
It's a good thing.
Yeah,
good
I feel that more and more actually, especially for countries like Lebanon, Pakistan, and many other countries in the region where the economic and political systems are not working, there's actually a lot more pressure and burden on these entrepreneurs to do things that'll overcome these challenges and make something happen.
Yeah.
So we need to support these type of founders and make sure that they have all the resources, all the support they need to be successful, because they are the ticket to a better future for most of the region.
And here's GV Ravi Shankar, the managing director at Peak 15, which is formerly Sequoia India, talking about what he looks for in entrepreneurs when he wants to invest. Just a reminder, Peak 15 manages nearly $3 billion in assets, and GV is typically writing a $20 million check.
Basically, for us, always boils down to market and founder, right? In any firm.
Market and?
Founder.
Okay.
Then
even at that level?
Even at that level, founders are important because very rarely do we intersect companies in Series B and Series C's where the founders step back and there's a CEO in the business. There's always a founder. The founder is still driving the show. And for many companies, up until they go public, most likely founders are driving the show. And so it's very, very important to calibrate for the founder and the quality of the founder and how they are. And there, it's a little bit more art than science, but as you have these conversations with them, you try and understand who they are as people, right? Because you want to see that these are gritty people because times are going to be tough. It's not going to be an easy walk in the park. So you want to see people that have been there, done that, gone through some, pain, because from that pain, they would have grown, right? Mm-hmm. And so if you have this mindset of growth, a growth mindset, and you say, hey, I went through trouble, from that I learned something, those are typically better situations. So if I meet somebody who's been always successful, usually I'm worried about that because I don't know how they're going to behave when things are not going well.
I think that's hard to find.
Yeah. It's hard to find, but I've had that experience. I've had a couple of situations where founders have had a very good life in the sense that they've been successful in what they do and they've not had to face a serious level of difficulty and which means they've not had the journey of self-discovery, if you will, right? And, building that grit, seeing that, okay, times are bad, but I can get through this and I've come to the other side. So people who have gone through those journeys are fundamentally much stronger and, they're going to not be worried when things are not going well. They know they got to dig in and fix things and they'll be willing to roll up their sleeves and do that. I think that's something that's important to see. And second thing is just how they think about life, their life experiences, what they've done, the choices they made, why they made those choices, some of their value systems. I think these are all softer things, but you pick up when you talk to them and how they think about life. Mm-hmm. I think that this, I'd say like some benefit of having done this long. And I'm not going to say that we get everything right. We sometimes get it wrong because people have also learned how to become better storytellers. Right?
Yes, of course.
So, while we are trying to hone our skill, they are honing their skill as well. Yeah, so people are good. Sometimes people are very good storytellers and you cannot, today everybody would start by saying, I'm solving a problem that I faced, right? Like how many of them have truly faced that problem? Everybody knows, but that's good to say because that makes a great story. If you say, hey, I grew up like this and I faced this problem. I started this company. I couldn't get a corporate card. Now I'm going to go build, the BREX for this region. But there are 8 people doing that, So the question is, did you fundamentally come from that place? Or you said, hey, I'm an ex-consultant. I look at global markets, which business work there, can I bring that business here? Many people start that. I don't think there's a value judgment on either of this. There have been very successful people who have brought models to a new region as well. But it's hard to know from the stories that people tell what it is. But if you do find somebody who is very authentic about why they started what they started, the reason it goes back to the same conversation on grit. The people that start these businesses are actually, very capable people, right? For the most part, they have high opportunity costs. So at the time when things are not going well, right? Are you going to sit there and think, I was a McKinsey consultant. If I had been in my job by now, I'd be a partner and, this is what I'll be making. Here I am, it's not going well. And if you're going to give up because your opportunity cost is so high, and you will give up if you're not authentic in terms of the problem that you're solving and how it speaks to you, right? And so we worry about some of that. And so the best founders have some way to identify that the problem, they really care about the problem they're solving and have a way to identify themselves with the problem. And that is good, not a necessity though, right? But my point is, look, we get it wrong sometimes because, people also tell good stories and then, not every founder transitions to being a great CEO. And that itself is a journey that people learn over a period of time. And sometimes you learn only through making several mistakes and there is a cost to that.
But at that point, GV, it's interesting that you're talking so much about the founder because, again, at that point, it's a $100 million plus dollar company. You know, they've probably been running for 3, 4, I don't know, maybe 5 years. So it's interesting that it's so important, even though you have more tangible things as well, right? Like you have their growth trajectory, you have their unit economics.
Right. So look, I think those are part of, I mean, very, very strongly part of the mix in terms of our how we diligence a company. We need to see unit economics pan out. We need to see growth trajectories. We need to see a path to profitability overall, etc. But I think it's very hard to take the founder from the equation.
Ultimately, whether you're investing in startups, whether you want to invest in public markets, in real estate, in gold, whatever your asset of choice is, it's very important to have your investment criteria very, very clear and to know yourself. Here's what executive coach, entrepreneur and financial expert Binod Shankar had to say.
The most important advice about investing is not so much about what to invest in or how to analyze investments, but more about psychology and your temperament. Let me explain what I mean by that. So if I look at myself and my people I've taught and my colleagues, a lot of people know about investing. They know markets. They know how to do a discount cash flow, for example. Or
not everybody, but
not everyone. Finance people, I'm talking about the finance world, right? These guys, the CFA charter holders, they know their stuff. And yet they make disastrous financial decisions, including myself in the distant past. And you think, why is that the case? And it comes down to temperament and behaviors and emotions. So maybe a few pieces of advice to your listeners, right? One is know yourself very well. And I know it sounds very cliched, know yourself. What does that mean? Well, know your risk appetite. Know your return requirement and risk appetite. So you might think, hey, I'm okay with losing X, but are you okay with getting half your investment wiped out? Think about that, right? When it happens in reality, it can be a gut-wrenching punch to you. So that's number one. Know your weaknesses, know your biases, know your risk awareness.
It won't happen, you know what I mean?
Yeah, they think they don't happen.
Because the markets, like if you look at markets, you've had a bull run for such a long time.
Correct.
And now all of a sudden everything's down. So maybe people didn't expect, like, you know, they thought they were too smart and then realized that they were riding a wave.
So this is what in finance we call availability bias. You look at the available information and what's available in your mind is what happened recently. And what happened recently for the last 20 years, we've had 0 interest rates and all asset classes doing brilliantly. People haven't lived through a cycle yet. They're now going through it, right? So that's one advice. Know yourself. Know yourself is your risk appetite, your return requirements, your biases. Everyone has biases and some biases are more destructive than others, right? Overconfidence being one of the most important biases. Like, I know everything. I've studied finance, blah, blah, blah. I've read these books. Okay. That's number one. I think number two, and this is not in any particular order, Loulou, right? Just as a list. Number two would be, don't get into this FOMO habit, you know, this fear of missing out. Because, you know, at one point in Dubai, Rome, if you go to any dinner party in 2005, 6, 7, 8, all you heard was real estate. Somebody made money in real estate from this one. Flipping properties, buying Porsches, buying luxury villas. And people are strongly tempted to do that. I would say just don't do that because what's meant for somebody is not meant for you. Again, goes back to my first point, knowing yourself. But FOMO is very powerful. It's a very powerful, a phenomenon. I've seen it happen a lot of the time. Like, let's all invest in crypto. Let's all invest in Bitcoins. Let's all invest in tech stocks. It's happening over time and again. And that's what builds bubbles, by the way. This FOMO fear of.
That's what?
Builds bubbles.
Builds bubbles. Okay.
In any market, whether it's crypto or real estate or anything. Right. The third point would be think long term. I think people like to, you know, think of money making as something very short term, trading mentality, you know. And I'm yet to meet a trader who's made consistent profits over the long term. They always end up for some reason losing money. And the reason is not weird.
And this is someone whose job is to do that. So imagine people that have other jobs and are trading and trying to do that.
So traders try to do what day trading, right? Try to catch that day. You know, they look at technical charts and all those fundamentals, and you know, look at screens and shoulders and heads and things like that, which weird terminology, right? And they still spend like tons of time on the screen and still end up losing money at the end of the day, right? Or at the end of the month. So that's another point. Think long term. People need to have a patient mindset. Building money takes time, very much.
So what you need to keep in mind is whether you are out there making money by taking outsized risks and being an entrepreneur, whether you are an investor making money in managing other people's money, or whether you are risk averse and investing in, you know, blue chip companies or real estate or, you know, some safe bets, as Binod would put it, things that don't make for sparkling dinner conversations. I think the most important thing to remember is integrity. And integrity is something that all of the entrepreneurs that I've had on my show have displayed, and it's so important. So this is an incredibly short snapshot of all of the great moments I've had in 2023 in the 19 conversations. I do invite you to check out the 64 other episodes of Conversations with Loulou. I'm sure you're gonna find them very insightful and you're gonna find them very relevant. Thanks for our sponsors, Capital.com, for supporting our show. We are actively looking for strategic sponsors for 2024. So if your vision and your values align with ours, please do reach out. Don't forget to subscribe wherever you listen to your podcast or you watch it. And please give us a rating and a review. It really helps in getting the show discovered. And if you haven't done so already, please share the show with colleagues, family, friends, and whoever might find this content relevant. And don't forget to fill out the podcast listener survey. It's totally anonymous, yet it really helps me get some generic insights about you, our audience. It helps me understand you better and deliver better content in the future. So please spend a few minutes. The link is in the show notes. And with that, let's welcome 2024 with some awesome conversations, shedding light on some of the world's most brilliant humans. So make sure you tune in.